Loving the Smart Property Investment Show? Then you're going to love tuning in every Monday to the Scouting Australia podcast, hosted by Sam Gordon, Smart Property Investment Show's most downloaded guest.
That always just triggers in my mind. Like I'm always wanting to look after people because of what happened to me there.
What are you waiting for? Listen to the pros at the Scouting Australia podcast, now on all your streaming platforms, and get educated.
This is a Momentum Media production.
Warning. The following episode contains content that may be distressing or disturbing to some listeners. Listener discretion is advised. Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello everyone, Grace Ormsby here. I am lucky enough to be having a very pivotal conversation, a really, really important one at this point in time. It is an absolute pleasure to be welcoming Peter White, the Managing Director of Finance Brokers Association of Australia, to today's show. Peter, thank you so much for taking the time.
Thanks, Grace. It's my pleasure to be a part of the program, so thank you.
We always love chatting with you, and it feels like a very important time to be having this particular conversation. Obviously, the news broke on Tuesday. The Reserve Bank of Australia handed down its fourth cash rate decision for 2023 at its monthly board meeting on Tuesday, 2 May. Australia's central bank opted to raise the cash rate by 25 basis points, again to 3.85%. Met with a bit of shock, a bit of surprise, a bit of resignation probably from across Australia. Peter, you're operating in a very cool position here. You've got a very helicopter view of the mortgage industry, and that's obviously where these rates very much play into morale and play into what's actually going on. So what are you seeing from your perspective at this moment in time?
Well, maybe I just sort of frame where my view is of the decision, and it's two sides of a coin, which is probably not really the right way to approach it. But very unlike me, I sided with CBA, and I don't do that very often. I expected rates to go up, but I hoped that they wouldn't, because we've done a whole lot of research, and we'll probably talk about that later, but it's one thing to be focused on data and being data-driven, and that has to be a major part of the consideration with the Reserve Bank making their decisions and determination for fiscal policy. But when we look at what's happening within the economy and move a bit beyond the data, because the data did say it needed to go up a bit more, right? There wasn't enough movement to justify not doing it, which is why I expected it would happen. But we are seeing in the marketplace the stresses and strains that are putting on people. And I spoke, it would have been, let's call it a couple of weeks ago now, at a Senate Select inquiry on cost of livings and how that's impacting home borrowers, investors, and all the different parts of the market, including renters as well. But the affordability piece, it's really having a strain on the marketplace. And the research we've done shores that up. So, I kind of hope that the Reserve Bank would have taken, I guess, a more considered approach to understand there's two parts or two sides of this coin. One is the data and the research and the economic factors. But when we look at what's happening with the economic factors, it's old data. It's not today. Like another month has gone by, but they're still in the month before sort of thing. So my view is they should have let it go another month to have the flow-on effect on what's happening in the economy to start and show in a more transparent and practical way, the real world stuff, not just the data says. Let's see what's practically happening with it. But you need a bit more time to do that. And the time just wasn't granted for that to actually happen. So I was disappointed they did it, but it is what it is. And there's probably still another one in there, another one rate rise still to come this year before we get into 2024. And then hopefully we'll start and see some reduction in interest rates, which I guess will be happy news for all investors somewhere. It's not an easy gig.
Yeah, it is something that we just have to wait out now, I guess, at this point in time. You talked about the fact that, the change did happen and the disappointment that came with that. What have been the conversations that you've had since? How are the banks or brokers responding to this? Where can, I guess, we see that flow-on effect come through in the market? Is morale really down?
It depends which piece of the market you look at. I think investors' morale is down. All they're seeing is, the increase of a lot of investors who have actually borrowed for their portfolios. seeing that rates going up and the challenges with the lease agreements as to what you can and can't do. And there's been movements in Queensland, you bring caps in and so on, but also being constrained within the actual context of tenancy agreements is what they can and can't do as well. So, it's difficult because from that part of the marketplace, your costs are increasing, interest rate costs. You've got a tenant that possibly can only afford so much. And again, I know we'll talk about research later, but the research is saying that rubber band is probably stretched nearly as far as it can go. So there's one thing to say, my costs have gone up, I should put rents up, but there's a practical place, but if I do, can they afford to do it? And I wind up with a tenant that doesn't pay the money. I'm glad I'm not in that quandary to any great degree, but it's a difficult one to sort through. But I do urge anyone who is an investor, and I guess in practice in the residential marketplace, is to consider that, I know things probably need to go up, but you need to consider, can they go up? Because otherwise you may have a tenant who can't pay and then you've got to find another one and all the hassle and drama that goes through. Or are you better off to try and manage through where you are for a little while longer? Because there is a strong expectation that come 2024 and hopefully in the first half, we'll see rates start to pull back again.
We'll talk about that a little bit later, but I want to get onto this research because it is, I think, really the most important time to be dropping this kind of information and getting it out there. We're going to take a break. We'll be back in just a moment with more from Peter White.
This year might just be the right year to invest in property. But before you jump in, do you have a low-rate investment loan pre-approved? It might be the right time to invest, but the wrong loan could dent your prospects for achieving the maximum return. Are you armed with the best finance at the sharpest rate? Find out with Finny. Call us now on 1300 002 023 and find out what you could save. Or visit our website, finny.com.au to book an appointment.
Welcome back to this very special conversation we are having with the Managing Director of the Finance Brokers Association of Australia, Peter White. Peter, thank you so much for taking the time today. I know how busy you've been, and I'm guessing you probably are this busy after every single rate decision that happens. But this one did feel, I think for a lot of people, I mean, you were expecting it, but hoping against it. But a lot of people, don't feel like the end is in sight. And I do feel like that this research reflects that position just a little bit. What spurred you on to go out and go, we need to actually get a bit more insight into how people are feeling at this point in time?
Yeah, thanks, Grace. So the research we've just released, it's called the Australian Mortgage and Rental Affordability Survey. This is the second time we've done this. So about 18 months ago, we did the same thing or similar thing where we went out to borrowers before the rates went up and said, look, how do you think you're going to fare if interest rates go up by 1% or $300 a month? This was before things started to move. And people said, if that happened, 57% of people said we couldn't afford it. That was 1%, $300 a month. We've 3.5 folded that number and we've gone way beyond it. But there hasn't been a steep increase of defaults or issues with our ombudsman, AFCA. AFCA, our ombudsman. So there hasn't been any sort of sign saying that that the egg's cracked and the world's screwed sort of thing. So fast forward to today, we sort of did that piece back then and said, oh, geez, that's problematic because this is my 45th year of being in the industry. And I've seen recessions, booms and busts, GFCs, you name it. I've been through it. And I was concerned back then as to what would happen because in extraordinarily low interest rate environments, it's not sustainable. It was always going to go up. So I was concerned to sort of say, well, where does the rubber band break on this? And that's what they said back then. And we look today and we redid the research knowing we've been through so much of the climb of interest rates. How are people going? And basically the research was, back then was forward looking to say, speculate and how do you think you go? Now we're here, we say, well, we've reached the future. Let's have a look backwards and tell me how you've survived and what you've done to do it. And this is what comes out in the data. And it's really interesting, I guess, to understand how resilient Aussies are, because I would have thought the rubber band would have snapped a while ago. I spoke at a Senate inquiry about 2 weeks ago on affordability. It was a Senate Select Committee inquiry. And, I used a bit of this data. It wasn't quite finished, but I pulled a couple of pieces out of it. And you sort of sit back and go, geez, we're a resilient bunch. We've really had a crack to keep things going. But there is now a but. We've done another 25 basis points I think I said before, I'm expecting another 25 to happen before the end of the year. But the research, the data we did looked at, how are you surviving from a financial impact, but also from a personal impact as well. So my strong interest in mental health we do for industry, and I've been recognised for things I do outside of that as well, to understand really how this is playing out. And again, it plays back to why I was so disappointed with the RBA, is there's no consideration for what people are going through. It's just data-driven. And the problem there, it's old data. It's not even necessarily 24 hours old sort of stuff. It's a month, 6 weeks or longer old. But what we've seen in the research is that when you look at what Aussies have been doing is 61% of people that were in this research have cut back on leisure and social activity in their weekly spending, which included groceries, 61%. So everyone's tightening the purse strings. And we understand low interest rate environments, bigger mortgages or cheaper mortgages, a lot more money to spend, kind of got to rein things in a little bit, sort of get that. But there's a point to it. 61% of people are already doing these sort of things. And then we look at, we hear the conversations from banks. They're saying, Aussie's got all this money in their bank accounts or in offset accounts or redraw capabilities. They're all cash surplus, if I can put it that way. But we found the research when we looked at those that had used those cash surpluses or were about to, there was 69% of people had already cancelled holiday plans. Now, I know when we all got out of COVID, there was a huge blood rush. People were going overseas left, right and centre. That seems settled right down. Around 46% of people have used or are using their funds that they had in their bank account, offset accounts, redraw facilities, 46% of people. So the cash backings are quickly sucking up what was there. And
that was always, sorry to interrupt there, Peter, but that was always one of the things that the governor, Dr. Philip Lowe, would bring up as to why everything would be okay, wouldn't it? That people did have all these cash reserves.
And it was correct. They were there, but now they've been used. And this is where I get annoyed, where the decisions get made. You should have left it another month, because this data will continue to reflect how people can or can't afford those mortgages. And you can't just base these decisions purely off the data. I know we're trying to balance inflation and everything's being done to do that, and I'm not disagreeing with the approaches, but the impacts of what's already been done as to what people have had to do to adapt are still playing out. Right? So you look here, again, in the research, almost 60%, 58% of people have either done this or are about to take on additional work to meet their commitments. They're taking 58%, taking on additional work, and 32% are in the process of or have sold assets to manage through. Now, you sort of go, well, it's not like people aren't having a crack to actually meet their obligations. And look, this is what happens in these marketplaces, but there's a point at which it's not sustainable. And the impact of the financial impacts on the borrowing marketplace will be a significant contributing component to pulling inflation back down, because it's just not going to have the money to spend, right? That will help, because that's rising interest rates is a key measure to actually pull running away inflation back into line. Well, if you don't have the money to spend, because what it does is it slows down their money, their cash flow. If it's already happening anyhow because of where we're at, maybe we just jumped a bit too far too quick. And it may have mean that it's not like there wouldn't be another rate rise, but it might have been 3 or 4 months from now that would have been more measured and more appropriate. And that might have been it for the year, because everything is pulling back so strongly. And then when we get into next year, we can look forward to those rate reductions. Yeah, it's interesting how that's happened, but that's just financial impacts. There's also a mental health impact as well that I touched on before. And one of the interesting pieces is that I found, anyhow, from my point of view, is that just under 20% of people were getting counselling support and psychologist support and so on, therapy support to help them mentally get through this. They were people 18 to 28, right? They're young people, not old fellas like me. Young folk are struggling with this. And the main reason that would be driving that, this is my view, is the fact they've never been through an interest rate rise. Yeah, I've seen interest rates go up and down. I used to do home loans at 18.5%. We do business and investment loans at another 2% above that. So I've seen it in pretty heady interest rate days. But it was 18% of people, just under 20% of people and they were aged in 18 to 28, seeking mental support help. And it's sad that that's what it's driven to. But that's a part of a dark cycle that people can fall into, which will have a negative impact on what they're doing. Because beyond this, there's increased tensions in the household, there's strains on personal relationships. And these are unfortunate normal outcomes of financial stress. So whenever somebody's under financial stress, we know families suffer, relationships suffer, mental health, stress, depression, anxieties, all go nuts. And it's it should be a part of a decision-making process. Because at the end of the day, if you can't afford to pay your bills because mentally you're so caught up in a black hole, then everything's collapsing anyhow. It doesn't matter what else you do. It's got to be a part of the equation. I'm pretty disappointed that I don't feel that it is. That's a me thing.
Have you ever seen it? You talked about, obviously, interest rates have been much higher in the past. You've spent a long time in the industry and looking at mortgages and talking to investors and owner-occupiers and everyone else who is involved in the property game. Have you ever seen it like this?
No, not ever. And this is why it's so unique and why we actually put a spotlight onto how people are going with their mental health through it. So through all these times, and you got to balance it. I can talk about, residential lending at 18.5%, 20%, business loans at 21, 22, 23%, and all that sort of stuff. But there's a balance in economies of scale with all that. You sort of, the borrowings weren't as big, costs of funds are a lot higher, but all that sort of stuff. But the reality is what we're seeing at the moment with long-term sustained low interest rates due to low cash rate environments, going through a pandemic and trying to come out the other side of that, which principally as a global problem, runaway inflation, everybody around the world is trying to rein this in. I've never seen that in, 4.5 decades, 45 years. So it is really unusual, but it's also why the struggles happen with mental health. Because it's not like we've had a chance to adapt to this. And especially over the last 11 years, where interest rates just come down, 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 down. And now we're in a period where I think, 11 out of 12 rate reviews, the rate's gone up and up and up and up. It stayed down too low for too long a period. And I can all be heroes in hindsight, so don't get me wrong. But it stayed too low for too long. And I spoke about this, it would be at least 12 months or more ago, that the RBA should be making small increments over a longer period of time. Is a lot easier to absorb than big steps. And although 25 basis points could be argued as not a big step, when you're doing it month in, month out, it's really big because you never get time to catch your breath and it's gone again. Oh, here we go. Yeah, it's harder. It's even harder than what it was last month. So it's a challenge. It's a real challenge.
I would like to say to anyone who is listening to this conversation and resonating with this, or if it does create some anguish or stress, there is help available, and I would really encourage everyone to talk to their friends or family or anyone in their circle that they can. Also, Lifeline is a very good option to be going to there, 13, 11, 14, 24-hour crisis support there. So please do reach out to people because it is so important, because at the end of the day, your life is more valuable than, any material goods. So please.
Yeah, it's a very, very great point. And the thing that people also need to remember, there are all these support services, even your bank can help out, but don't be scared to put your hand up and ask for help. And I think a lot of people get very, I'll work my way through it sort of thing. Yeah, don't be hesitant. The best thing is to get help sooner, not later. And there's a whole lot of people there willing and waiting for your call. So, yeah.
There is absolutely no shame in that. We will take a quick break now. We'll be back in just a moment with more from Peter White. Welcome back to this very special conversation with Peter White, Managing Director of Finance Brokers Association of Australia. Peter, it's been great to hear your insights, and it's obviously getting to a bit of a pressure point. There's a lot of stresses being placed on individuals across the country, and the economic situation has been quite interesting this year. We're obviously coming off the back of a COVID-induced lift in property market values, and that's no longer the case. I guess really mortgages and what's happening in the property market work very much in tandem. If one lifts, the other lifts. Where do you see kind of the property market actually going from here? You mentioned that rates, you're expecting at least another one before the end of the year. Will that happen sooner rather than later?
Well, Grace, it's always a $64 million question, but look at this piece of data. So I can see from the end of last year to yesterday, that's how accurate the data is, the average loan size in Australia has dropped by about 10%. People have borrowed 10% less. Mm-hmm. That showed that there is constraint in their ability to access credit, which impacts their ability to buy at a certain price point. So from the property marketplace, and remember, this is general rhetoric, and the property marketplace is so specific to not just suburbs, but even streets. I know where I live, one side of the street's a lot more expensive than the other. It's on a river. So if you're on the river, you pay a lot more than the other side of the street. There's neighbouring postcodes that are 2 minutes away that have huge price differences and different market impacts and trends. So, I say this with general comment, and I know some people say, well, that's not happening here. Well, I get it. It's not happening there. But, we are still seeing in pockets that those inflated property prices during COVID that happened are certainly pulled back. And they, in certain areas, are still coming back, even though I think generally there is a more flattening in the marketplace. But with that in mind, as a general statement, if we get another 25 basis points rise before the end of this year, then that puts further pressure on people's ability to borrow money, which means they can't borrow as much, which if they don't have equity or if they don't have extra cash, will reduce what they can actually purchase a property for. So that has still a risk of trend of pulling certain property prices down because people can only afford so much. So I might want to buy property for 1.1 million, but I can only afford to buy something at 900 grand. So that has a risk of potentially creating pockets that are struggling to move and may come back even further, try and match where people's borrowing capabilities are. And it's a real mixed match around the country. So don't get me wrong. And there's because of the impact of credit or the access to debt that people can get to purchase, and then the differential between what they can borrow versus what equity or cash they have takes them to a certain limit. I can only buy something at this amount. And if credit interest rates go up, it means you can borrow less because you can only afford a certain level of repayments. Then that means you can only afford something at a lower property point, which may mean that some pockets will pull back to try and match that. Otherwise, they're going to have property sitting on the market forever and a day, which may be okay, may not be okay. And then we look at next year, and I'm extraordinarily confident rates will come back next year. How much? I don't know if that's 25 basis points or 50 basis points. My gut says it's probably 25 for most of the year, like one rate drop, one step. But when? Don't know. It's all subject to these indicators, as the economic indicators, as we get closer to that point, will then start to dictate as to when that is possibly able to happen. So, there's one thing to say, well, hang on for the ride, don't sell the property too cheap. Can you hang on to it for 12 months? Or is it 18 months? It's individual. It's very individual.
Absolutely.
But with everything, over the entire time I've been in this industry, it will cycle around. Right? It's not like we're stuck in this hole forever. It won't happen. It's a bit hard to understand when do we get out of it, but we will get out of it. And property prices will go up again. Right, because that's the way the market is, and that's the normal cycle of real estate over time. This isn't a 6-month game that we're playing with. In general, you look at property prices over 30, 40 years. I know that the first house I built, including land, cost me 57 grand. I can't even buy a pocket for that much.
Those were the days. I mean, Peter, it is good to hear that there is light at the end of the tunnel. Obviously, we cannot crystal ball gaze as much as we would like to work out when exactly that is. But one thing that we haven't touched on yet that I think we do need to talk about before we do finish up this conversation is on that refinancing piece, because there are a lot of people that are just riding the wave of their bank lifting their variable rate every single month in reaction to the RBA. And what are your thoughts on this and what people should be doing or can be doing at this time just to look after themselves?
Sure. So I've got some very strong views on this. Let me put it that way. But not sink the FBAA too far into it. That I'm calling on the Treasurer to make sure that we get proper levels of disclosure to the marketplace, whether investors or owner-occupiers, as to what the reality is of the rate they're taking up. Now, if I go back in the day, we used to have things called honeymoon rates. And that said that here's a variable rate, but it's only going to be like this as a discount for 12 months. Then you're going to pay the existing borrower rate, which is a lot higher. And in those days, could have been up to 1% higher. Now, in today's marketplace, based on the Reserve Bank's data, there is still a pricing differential, a difference between new borrower rate and existing customer rate of roughly 0.5%. So the thing that everyone has to watch is before you get carried away with cash incentives by lenders saying, hey, I'll give you $4,000 or $10,000 or whatever it may be, do the maths and have a look at what the existing borrower rate is, not just the rate they're giving you. Say, okay, I'm going to give you a pocket full of cash. I'm going to give you the world's best interest rate. Here's the deal you can't refuse. You know what? Nothing's free. You need to do the maths to say, does this actually work out for myself? I need to look at what is the cost to refinance? Do I have to pay some more stamp duty? Is there new valuation, legal costs? Do I have to pay lender's mortgage insurance again? What are the lender's fees that are involved versus how much cash I'm going to pay and versus how much I'm going to save and potentially how long? You know, am I only going to get this wonderful rate that makes me feel great for 6 months, maybe 12 months? And then do I have not just an RBA jump, I've got another 50 basis, half a point, 0.5% more again on top of what the Reserve Bank's doing, right, to push things up. So you need the maths. And to do the maths properly, I implore everyone, get yourself a broker. They live and do this every day. And, you know, it's a bit like building somewhere or doing a development. You know, if you're an investor doing a development, you're not the ones going out there laying the foundations of concrete and putting the walls up. You've got a builder, an expert to do that. It's the same thing. Get an expert to guide you. They've got a much broader range of products than what a bank has got. Because obviously they've got many banks in the portfolio. They're governed by what we now these days call a best interest duty. So they're governed by law to put your interest first. And if they don't, it's $1 million fine. And I can assure you there ain't no one going down the path of $1 million fine. They're all looking after your best interests. That's get an expert to guide you on it so that you understand it. And it may work out. It's the right thing to do. Let's refinance. Let's get a better deal. What I want to see is transparency of that, because these days that transparency has gone. We've all been through the Haynes Royal Commission and all that stuff back years ago now. And it was all about a lack of transparency. And here we have a very problematic piece. People are making decisions that aren't informed in the manner of which they should be. And it's important that happens. So I'm calling on the Treasurer and the Financial Services Minister to jump into the middle of this. I'm actually seeing the Financial Services Minister next week. It's budget week. I'm in Canberra, so I'll be banging.
Makes sense.
Yeah, but it needs to be transparent. You need to understand, because you're only hearing half the story, and that half the story may sound great, but the other half story may not. And the whole thing may make sense. So don't get me wrong. I'm not saying, oh, wait, get an expert to guide you, get a mortgage broker to do the work for you. It's going to take a lot of heartache out of it. Let them do all the spade work for you and find the information. But that's what they're there for. And at the meantime, we'll keep banging on government and regulators' door to ensure that transparency plays out. But, you know, in all fairness, the banks should be doing this. If they want to be seen as trusted people in the marketplace, they should be very open to say, we're offering you this rate today, and just be aware our existing borrower rate is this. It's about 0.5% higher. Yeah. I think they should be, and I think the laws in this country actually state they should. What we've lost is, from the old days, we used to have these things that were made out of paper, and they were called newspapers. We used to read them, and they'd have big ads in them, and the disclaimers used to be in that. Now we do everything digitally, just not there, or it's so fine you can't see it. So,
it's a good point you make. Unfortunately, hopefully, I mean, are we headed for another Royal Commission into the space? Wouldn't want to see anyone trapped.
I'm calling on an inquiry. I'm calling on an inquiry to the space. In all reality, with a lot of these things, if people wanted to, they could do the right thing and fix this. The problem is a lot of them won't, but we are calling on an inquiry into the lack of disclosure of new borrower rate versus existing customer rate, and then these cash incentives that are drawing people into their fold, potentially under a false premise.
I guess that is an amazing warning to be giving out to people there, Peter. Thank you so much for your time. It's been an absolute pleasure to chat with you once again. We'll obviously keep this conversation ongoing, because while the Reserve Bank still looks to be making changes month to month, this conversation will need to be ongoing. So, Peter, again, thank you so much for your time today.
My pleasure, Grace. Thanks so much.
To everyone who is listening along, we hope you have enjoyed this conversation. Please like or review us on whatever platform that you do listen to your podcasts on. If you have any questions, please do not hesitate to reach out, editor@smartpropertyinvestment.com.au. Stay up to date with us on our social media, Facebook, Twitter, and LinkedIn. That's all we have time for today. Until next episode, stay safe and well wherever you're listening from. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are you looking for a new challenge that combines your existing skills with the exciting world of mortgage broking? Well, listen up, because we've got the perfect opportunity for you. Introducing the Advisors New Broker Academy 2023, a free event designed for professionals just like you who want to learn how to become a trusted broker for their clients. Coming to Brisbane, Melbourne and Sydney in June, you'll learn from industry specialists and gain crucial industry insights and intelligence to become a go-to broker. You'll also have the opportunity to network with brokers at all levels and gain a competitive edge in the marketplace. Register now for free at newbrokeracademy.com.au and join the top brokers of tomorrow.